Hey everyone, it's Lawrence Mack here from Remax Realtron. I'm here joined again with Chris Mulder from Trideck Mortgages. Hi Chris, how you doing?
Lawrence, very well, thank you. Thanks for having me.
Excellent. Well, today we wanted to go through the topic of Canadian citizens that are moving back from the US and they want to buy property. That's roughly the topic, and I'm sure there's a lot of different pitfalls and information that we need about that. So Chris, can you talk about that? Let's just take the scenario, for instance, of somebody who is a Canadian citizen and they lived in the States for the last few years. They worked there and now
Yes.
they want to move back because of COVID or whatever other situation.
Because
What
of the
exactly do they
impending
need that
US
person?
election.
Probably maybe regarding the US election, but what else, what type of information do they need and what are the different qualifications that are different than the
Right,
visitor?
right. So if you're a Canadian citizen returning to Canada, we
Mm-hmm.
have to be very, very specific about defining circumstances. So the scenario is you're Canadian, you are returning to Canada. The most important question from a mortgage point of view to qualify for your mortgage is where your income is being earned. It stands to reason that in order to apply for a mortgage, you have to have income. So if you are, and especially with the pandemic, we're finding a lot of Canadian citizens are able to still maintain their work in the US, but work remotely.
Mm-hmm.
So if you are earning your income outside of Canada, you are deemed to be a non-resident. And if you're coming from the US, you must have at least 20% down payment if you are deemed to be non-resident. And again, the definition of non-resident is not that you're Canadian and living in Canada. From a mortgage point of view, it is where is your income being earned? Clear as
Got it.
mud,
Yep,
right?
so far so good.
Okay. Now, if you're Canadian returning to Canada and you have a job lined up in Canada, then it's very much business as usual. So if you're purchasing a home under $1 million, you can qualify for high ratio mortgage insurance, fine with the minimum down payment, 5 to 10%. And in many ways, you're treated like anybody who has been in Canada for an extended period of time. One thing that will be important to the mortgage lender in either case is your credit history. So it's a good idea if you are living in the States to actually establish Canadian credit. That's really important. If you don't have a Canadian credit bureau and it's only a US credit bureau, the lender can look at that on exception, but ideally you have established credit in Canada.
So even though it's still using TransUnion or Equifax, they're considered separate systems, even though it's like the same company that does that?
That's correct.
Okay.
That's correct. Yeah. And so those are the two important considerations. Where is your income being earned and what type of credit history is available in both countries? But in both cases, it certainly can be done. And I think to add some further context to this, it might be interesting to talk about what if you're a US citizen
Right.
wanting to move to Canada, right? And so the first consideration is having status here in Canada, because if you are deemed to be not Canadian, so not a permanent resident, moving to and not married to a Canadian, then you're going to be a non-resident. And specifically, Lawrence, maybe you can add some color to this. We have a non-resident speculative buyer's tax.
Yeah, so unfortunately you'll
Golden
have to
Horseshoe.
pay an additional 15% if you're not a resident of Canada, here. And also if you're buying property in like the Golden Horseshoe. So that's roughly what it is, but there's some details involved with that.
Right. And so there are areas outside of the Golden Horseshoe where you could buy without the speculative tax, correct?
Correct.
And I think it's also worth mentioning that if you pay the tax and subsequently become a permanent resident, then you can request a full refund of the tax that you've paid. I think you're given a 12 or 24 month period to do that. And so that's available to you.
Yep.
So yes, so coming back to the scenario of a US citizen, if you hold US citizenship and you want to purchase real estate in Canada, Again, we have to define the two scenarios, which is where is your income being earned?
Mm-hmm.
If you are earning your income in the US and would like to buy in Canada, you're deemed to be non-resident. And as such, you will have to purchase with at least 20% down payment.
Right.
Okay. But if you're a US citizen who moves to Canada, has employment in Canada, and pays income tax in Canada,
Mm-hmm.
then you can qualify under a mortgage program called New to Canada. And so as long as you've landed, you don't have to necessarily have citizenship status. You can be here on a work permit, but your employment is here. You can qualify for high ratio mortgage insurance under these special New to Canada programs.
Right.
So the difference between all these different scenarios that we've discussed can be, is very subtle, the nuance of it. And it really, what defines it is not if you're Canadian or American, if you're living in the US or living in Canada. What matters most is where you're earning your income from the perspective of a mortgage application.
Yeah, sounds good. So going back to the information of when you're moving to Canada, what about if you have property in the US? Like, how does that work in terms of other calculation or what the banks would consider?
Yes, good question. That debt would be added to your current liabilities, and you would have to demonstrate the ability to qualify for whatever liabilities you have in the US
Mm-hmm.
and whatever liabilities you have in Canada. It would be treated no differently than having a second property here in Ontario, for example.
Okay, so if I owned a property in New York or own a property here, it just has to do with the level of debt service that I would have for my mortgage amount?
That's correct. Yes. And again, when we do the credit searches, credit reports, the mortgages will report on the credit
Mm-hmm.
report. So it'll be very easy for a lender to determine that you have debt in the US.
Okay, that sounds good. And this is more related to, I guess, what we'll call A lenders, which are just the banks. But I guess if you get
Yes.
more towards the private lenders or B or C lenders, I guess the criteria would be different.
Yeah, they're going to assess it a little bit more pragmatically.
Mm-hmm.
But certainly if you are earning your income in the US and require financing here in Canada, they're going to still do the debt servicing ratios. They'll probably relax the ratios a little bit,
Mm-hmm.
And they'll be a little bit more flexible, but they'll still treat it very much like any application for an applicant here in Canada locally.
Right. And you also mentioned, again, if there's is a little bit of a nuance, if the spouse is here, let's just say, for example, the spouse is a Canadian citizen, but
Yes.
but the main principal would be in the States. How would that work, or is that just really detailed that best for somebody just to contact you to ask you, because I'm sure there's a lot of nuances.
Right. So you have a US citizen married to a Canadian citizen.
Sure.
The good news there is that because of that marriage, there is no non-resident speculative buyer's tax.
Mm-hmm.
So you would not have to pay that tax if you have a Canadian spouse. So that's good news.
Mm-hmm.
And then the question will be, where is the income being earned, in the US or in Canada? But it certainly can be done, and the lenders are quite accommodating to the different scenarios.
Great. And then there's also the situation when retired people are moving back. So maybe
Yes.
they may not have the income, but they're retired and they want to, dissolve their assets in the States and come back to Canada. And in that particular case, what could you do in terms of financing, or what is the best way for that to move forward?
Yeah. So there are two ways that retirees can finance the property.
Mm-hmm.
The first way, and probably the better way because it has a lower interest rate associated with it, is to participate in a net worth program. So
Mm-hmm.
some of the banks have specific net worth programs where if you can demonstrate a certain level of assets to cover the mortgage, the lender will use that instead of traditional debt servicing. So they're not going to look at your cash flow. They're going to look at the level of asset that you have. Worth noting that the assets have to be in a Canadian institution.
Mm-hmm.
So if you have stocks, bonds that are in the US, or cash savings in the US, in a U.S. institution, it can be in U.S. dollars, but not in a U.S. institution,
Right.
then they won't count that. So they want it here in Canada in a Canadian institution. So that would be the first way. The second way is via a reverse mortgage.
Mhm.
And reverse mortgages are probably something we can reserve for another video.
For sure.
But the deal with the reverse mortgage is that if you're over the age of 65 and have equity built up in your home, you can get up to about 50% of the value of your home. And this is done without showing any net worth and without showing any income. So it's a really unique product, and we're actually seeing a lot of utility for reverse mortgages, and I think we'll save that for another video.
Great. We'll save that for another video next time. Lastly, you mentioned that these are if you're moving from the US and coming back to Canada. What about internationally though? Is it slightly different if you're coming back from, say, UK or something like that?
Yeah, so if you're non-resident, moving from anywhere outside of the North America, or really just the US, I should say, because Mexico would be the same. So if you're returning to Canada and you're a non-resident, meaning that you're earning income outside of Canada, then you must purchase with 35% down, not 20.
35%.
So the required down payment increases to 35%.
Okay, and again, this is just anywhere outside the US. So again, if you're just coming from like France or Italy or somewhere like that, it's still 35%. It's not about the financial systems.
That's correct. Yes.
English speaking.
Yeah, that's right. Yeah. And I've had clients who work for international schools. They're expats working in the Middle East or in Hong Kong or China, and they have real estate here. They want to purchase an additional investment property. And again, it's not defined by are you a Canadian citizen, it's defined by where is your income being earned. It's earned outside of Canada, you're non-resident, and you must have 35% down.
Wow. So it sounds like a lot of details. I really highly recommend that if anyone has a particular unique situation to talk to with Chris, so that we could figure out the little nuances of where you live, where your residency is, what type of property you own, where you earn your money, where your spouse lives, all that kind of stuff. So it sounds like there's a lot of different options that really you should talk to a professional like Chris to figure it out.
Thank you, Lawrence. Yes, the doors are open to anybody. You can visit my website, tridacmortgage.com, or find me on Facebook at Tridac Mortgage, or just Google Chris Mulder. You'll find me there.
Excellent.
I can't hide.
Can't hide all around. So that's it. So if you have any questions, please call Chris Mulder at Tridac Mortgages. Have a good day.
Thanks, Lawrence.
All right. Bye-bye.